Welcome back. You're watching Markets at Noon, and now to talk on the fundamental long-term perspective of the market, we have with us Mr. Nilesh Shetty, Portfolio Manager, Quantum Advisors, joining. Nilesh, good afternoon. Thank you so much for giving your time to ET Now. It's a pleasure talking to you this afternoon. Mansi this side.
Hi, pleasure being on your show.
Nilesh, to start with and understanding the market, well, the recent correction has made valuations in certain pockets of the market really very attractive. There's no doubt where we say that it is absolutely a stock picker's market. So, which are the pockets where you see value generating amid this volatility? And when the dust will settle in, where do you see the traction coming in to start with?
Yeah, I mean, the uncertainty around tariffs has given an opportunity for stock pickers to sort of pick up stocks that they want to pick up for the long term. Again, the assumption is that a lot of this uncertainty will fade in a few months. I mean, we are seeing opportunities uh, coming up in logistics where we are finding a name getting closer to a level where we want to buy. Some pharma stocks are getting interesting for us. We continue to have a large allocation to private sector banks as well as stocks linked to the saving side of the household balance sheet, including asset management companies, insurance companies, as well as broking companies. So there, I think valuations remain fairly okay for us, where we continue to have allocation, and also we have large allocation to IT services and consumer discretionary stocks, where we think at least for the next few years valuations look reasonable.
Nilesh, hi, afternoon. This is Kavita. And since we are talking on the lines of valuation, I really want to understand the connection between now earnings growth and valuations. Are you still sensing a disconnect in few pockets? And having said that, the rest of the 6 months for this calendar year, it's going to be on the name of large caps. So what are you analyzing?
Yeah, in certain sectors, there has been a disconnect for many years now. You saw that in consumer staples. So these stocks were trading at a very high price to earnings ratio from, say, for a better part of last decade. Post 2022, they've been underperforming because, I mean, the valuations that they were getting versus the earnings that they were delivering, there was a big gap. Uh, Recently, I mean, you have seen some recovery in these stocks because of investors wanting to have some defensive names in their portfolio. But otherwise, they still remain very, very expensive. We see that in capital goods as well. Last 3 years, there's been a boom in these stocks. Uh, Again, the assumption is this is not sustainable, these valuations. As earnings normalize for these companies, suddenly you realize, why are you paying 70 times, 80 times to these sectors? So again, our sense is these are the two pockets where valuations look not in line with their long-term averages, and investors need to be careful.
So investors need to be careful. Hi, Ankur, this side. I want to understand from you which are the sectors you're looking at. If you talk about recent parts, especially in terms of earnings, there has been clear distinction between private banks and public sector banks. How do you look at it?
Yeah, we've always favored private sector banks. I know sporadically public sector banks tend to do well, especially in times where sort of NPA cycle remains very benign. But that is not the norm for these public sector banks. The norm is they continue to have much higher NPAs than private sector peers, and which catches up with them. So, in trying to value these companies when the NPA cycle is very low, is not the correct thing to do. You may want to normalize that and bring it back to long-term averages. Then suddenly the valuation doesn't look that attractive for public sector banks. Private sector banks, of course, are far more efficient. They continue to price credit a lot better than public sector banks. And at least our allocation has been sort of favoring towards private sector banks. And within that, private quality private sector banks. We're not that allocated to tier two private sector banks, where we think, again, because of this aggression in growth and trying to grow book, they tend to sometimes rival public sector banks in non-performing assets.
Nilesh, one more thing. Considering the festive season, which will start from here on and will stay till the end of the year, what are those baskets, bouquet of spaces which one should eye? The consumption space, let's say the travel tourism. Is it something which will follow from here on? And yes, one more thing about the IT sector. Do you think it is not now a near term story anymore?
Yeah, the consumption space, you have to be careful because the festive season is slightly earlier than last year. So the numbers, near-term numbers may show a spike in sort of demand and other things versus last year. But that is not sustainable because as the base shifts, and last year because festive season was later, suddenly you realize those numbers are not sustainable and you correct. But over the medium term, I mean, we continue to have large allocation to two-wheeler companies. where we think valuations remain reasonable. We've trimmed a lot of them, but we continue to have a decent allocation there. We continue to have an allocation to a large tractor conglomerate, where we think they're doing very well in the passenger vehicle space, including some of their new launches. But these are the places where we are allocated to. On IT services companies, again, we think the long-term opportunity remains fairly bright. It is in the near term because of this uncertainty in terms of what is happening in the US, which remains a major market for them. Even for their customers to commit large capex is not easy. And you've seen a deferral of discretionary IT spends, which has delayed sort of a recovery in their numbers. But looking at where valuations stand relative to their sort of 5-year, 10-year averages, they remain very attractive right now. So we continue to have a large allocation, but you may need to be patient as an investor there. You may have to see a couple of quarters of more pain till things settle down in the US.
Right, Nilesh, having said that, I really want to know now, looking at the volatility and uncertainty looming around, I really want to understand or get a sense of your cash book. How much of a cash are you sitting on, or what's the house philosophy on these terms?
Yeah, so our current cash levels are around 12%. So cash is a residual for us if we don't find names where we can deploy capital and we are happy with the existing weights in the portfolio of the stocks that we own. What remains is cash. But again, if tomorrow we were to find opportunities where we think valuations are attractive and the company meets our liquidity and governance norms, we're happy to add. It is slightly above long-term average. Our long-term average has been about 10%. It is currently about 12%. But like I said, in this correction, there are a few names which are getting closer to the buy limits that we have for these stocks, and you may see those cash levels come down.
You mentioned about your cash levels, which got our attention. I want to understand, is it more of a time-wise strategy from 3 months down the line or 6 months down the line you may deploy that, or it is event-wise?
No, it is actually just individual stock specific because we are a stock pickers portfolio, the portfolio that we build. It is just that we have not found individual names that we cover in our research database of 200 companies coming below a buy limit at the moment. So because we don't find opportunities to deploy, what remains is cash. But if tomorrow 3 stocks were to come below a buy limit in this correction, we will aggressively buy into those names, and suddenly you will see cash levels come down.
Nilesh, one more thing. What's your view in the banks and financial space? And when I ask that, I'm trying to compare the PSU bank space with the private bank space. You see a lot of news flows coming in, one such which we have for the ICICI Bank, and that's the reason we see an impact. And in comparison, at present, the PSU bank space is doing well if you compare both of it. What's your take on the banks and financial, and in particular PSU bank and private bank space?
We are probably contrarian to the market view right now. We have a large allocation to quality private sector banks. We think valuations for that particular data set right now is far below their long-term averages. While for the PSU banks, we think the valuations are above their long-term averages. And for the quality of the banks that they are, perhaps you should be careful giving those valuations to these banks. I mean, the private sector high quality banks have been time-tested, proven management quality over last multiple cycles. While in case of PSU banks, you see in every cycle they tend to do very badly, probably because of mispricing of risk, which I don't think is changing materially. So our allocation primarily tilts towards private sector banks. We have a one PSU bank, which is the largest in the space in our portfolio, where we think pricing of risk is slightly better than other PSU banks.
Nilesh, how are you looking at the universe of small caps and micro caps? You know, this is one category which definitely you need to be cautious, but as a long-term investor, you really cannot let go of mid cap and small cap. Although we cannot take mid cap and small cap in one breath now anymore. But having said that, large caps you do need for stability and for consistency in the portfolio, which should be the bet right now, looking at the current scenario. But having said that, what if you really want to, you know, give a boost to your returns by having select and quality small caps? What is going to be your bet here?
Yeah, I mean, we are, in terms of strategy, we are market cap agnostic. We will go where we think valuations are attractive as long as the company meets our liquidity and governance norms. But like I said, in the rally that has unfolded in the last 5 years, especially after COVID, the small and mid cap valuations have been very, very high. And to get names which make sense at valuations that we are comfortable has not been easy. So we actually have a very low allocation to that space right now. And we are happy to, I mean, you may, in the process of trying to boost your returns and trying to allocate to this space, you may destroy a lot of returns because you're overpaying for some of these stocks. And like I said, this stock traditionally has been run by managements which are not of great quality. And especially when liquidity dries up, the correction in share price can be very, very sharp. And if you're trying to take an exit at that point in time, you might see significant losses to your portfolio. So we've always been very careful of the valuations that we want to pay for businesses. And right now, across this space, getting businesses that make sense in terms of valuations is not easy.
Felt like a 360-degree analysis, quite insightful. Thank you so much for your views on the market and fundamental analysis, as well as your sector-specific approaches. Thank you and have a nice day to you.